On the morning of September the 15th, 2008, Lehman Brothers CEO Richard Fuld arrived at the firm's 7th Avenue headquarters in New York City. The building's lobby was already filling with employees carrying cardboard boxes packed with personal belongings from their cleared-out desks. In a single weekend, without a government rescue, $158 billion in assets had become the subject of bankruptcy court. A bank that had survived the Civil War, 2 world wars and the Great Depression was gone before the markets opened on Monday morning. The question that no one on Wall Street could answer that day was not how Lehman had fallen, but why Washington had let it. In 1844, a German immigrant named Henry Lehman opened a dry goods store in Montgomery, Alabama. Within a decade, the Lehman family had pivoted from selling fabric to trading cotton for southern planters. Cotton was the oil of the 19th century, the raw material that moved entire economies across the Atlantic world. By the time the Civil War ended, Lehman Brothers had established a foothold in New York and entered commodity markets. From commodities, they moved into railroad bonds, then municipal finance, then corporate underwriting across America. Lehman helped take public companies like Sears, Woolworth, and Macy's, names that defined American retail for generations. By the mid-20th century, Lehman Brothers was one of the 5 most powerful investment banks on Wall Street. In 2007, the firm reported net revenues of nearly $59 billion across all its divisions. It employed 28,000 people across offices in New York, London, Tokyo, and more than 20 other cities. For 164 years, Lehman had survived depressions, wars, market crashes, and internal power struggles. It looked by every external measure like an institution too seasoned and too embedded to fail. By the early 20th century, Lehman Brothers had moved far beyond Alabama cotton into the beating heart of American capital. The firm financed some of the most recognizable names in American commerce, Sears, Woolworth, and Macy's among them. When the railroads needed capital and the textile mills needed credit, Lehman Brothers was the institution they called first. By the 1960s, the firm had helped reshape how American companies raised money through public equity markets. In 2007, Lehman Brothers reported a record net income of $4.2 billion in a single year. Its balance sheet held over $690 billion in assets, larger than the GDP of most nations on Earth. Richard Fuld, who led the firm for 14 consecutive years, was called the gorilla of Wall Street by those who feared him. Inside Lehman, the culture of risk was not a warning. It was the engine, the identity, the source of every record quarter. The firm's stock price had climbed over 900% across the decade preceding the crisis, rewarding every believer. No analyst on record in 2007 publicly predicted that Lehman Brothers would cease to exist within 1 year. By 2006, Lehman Brothers held tens of billions of dollars in mortgage-backed securities on its balance sheet. These securities were built from thousands of individual home loans bundled together and sold as a single financial product. The logic was seductive. If one homeowner defaulted, the losses would be absorbed by the larger pool of performing loans. Diversification in theory made the product safe, but that theory rested on one hidden assumption. The assumption was that home prices across the United States would never fall simultaneously in every region at once. Between 2000 and 2006, they had not fallen. So the assumption hardened into institutional certainty. Lehman deepened its exposure by borrowing heavily against these assets through a process called repurchase agreements. In a repurchase agreement, a bank sells assets overnight for cash and promises to buy them back the following morning. This mechanism allowed Lehman to fund long-term illiquid positions using short-term overnight money every single day. The firm was, in structural terms, borrowing short and holding long, a configuration that requires permanent lender confidence. Lehman also used an accounting maneuver known internally as Repo 105 to conceal the true scale of its debt. Under this maneuver, assets were temporarily moved off the balance sheet before quarterly reporting dates and then quietly returned. Investigators later confirmed that this practice masked roughly $50 billion in liabilities from public view each quarter. When housing prices began declining in 2007, the mortgage-backed securities lost value across every region at once. The diversification model collapsed because the underlying loans shared one fatal correlation. They all depended on rising prices. As asset values fell, the overnight lenders who funded Lehman's positions began demanding more collateral or refusing to roll over. A firm that must refinance billions of dollars every single morning cannot survive even 1 day of lost lender confidence. This is the mechanism, not fraud alone, not greed alone, but a structural dependency on perpetual trust in a system built on one bet. Today, Money market funds and certain leveraged ETFs operate on comparable short-term funding structures with long-duration exposures. The instrument changes with each decade, but the architecture of borrowing short to hold long has never left the financial system. On September 10, 2008, Lehman Brothers reported a third-quarter loss of $3.9 billion. That number confirmed what the markets had suspected for months. The firm was bleeding out from the inside. CEO Richard Fuld had spent weeks privately lobbying the US Treasury and the Federal Reserve for a government rescue. Treasury Secretary Henry Paulson refused to authorize public funds for a Lehman bailout, a decision made deliberately. Over the weekend of September 13th, Paulson summoned the heads of every major Wall Street bank to the Federal Reserve. The message was direct. The private sector must absorb Lehman, or Lehman would simply cease to exist by Monday morning. Barclays of Britain and Bank of America both examined Lehman's books and walked away from the negotiating table. At 1:45 in the morning on September 15th, Lehman Brothers filed for Chapter 11 bankruptcy protection. The filing listed $613 billion in debt, the largest bankruptcy in recorded American history. 25,000 employees arrived at offices worldwide that Monday to find their access cards no longer worked. In London, staff carried personal belongings out of the Canary Wharf Tower in cardboard boxes under press cameras. Global credit markets froze within hours as counterparties across the world scrambled to calculate their exposure. The Reserve Primary Fund, a money market fund holding Lehman debt, broke the dollar, falling below $1 per share. That single event triggered a run on money market funds globally, a sector previously considered as safe as a savings account. The question governments had not prepared to answer had now arrived. How far would the contagion actually travel? When Lehman filed for bankruptcy on September 15, 2008, not every firm on Wall Street was caught unprepared. Goldman Sachs had quietly reduced its exposure to mortgage-backed securities throughout 2007. Their risk managers had identified the housing market as structurally unsound and began building short positions against it. By the time Lehman collapsed, Goldman had already hedged billions in potential losses through credit default swaps on mortgage debt. The transferable principle here is surgical. The institution that survives a crisis is the one that acts on internal data before the market confirms the danger. John Paulson, a hedge fund manager then largely unknown outside specialist circles, had studied the subprime mortgage structure in detail. He recognized that the underlying loans inside mortgage-backed securities carried default probabilities that the ratings never reflected. Paulson's fund bet against those securities through credit default swaps and earned approximately $15 billion in 2008. His principle was different from Goldman's. It was not institutional hedging, but concentrated conviction built on original research. He did not follow consensus pricing. He followed the documented behavior of the borrowers inside the bonds. A third group of survivors were smaller regional banks that had never entered the mortgage securitization pipeline in the first place. They held traditional loan portfolios, maintained conservative leverage ratios, and carried no exposure to collateralized debt obligations. Their survival was not brilliance. It was the absence of a specific temptation that destroyed institutions 10 times their size. The pattern across all three survivors is the same. Each had a clear and honest account of what they actually owned and what it was worth. In modern finance, that clarity remains the rarest and most valuable form of risk management any institution or individual can practice. The mortgage-backed securities that destroyed Lehman Brothers have a living descendant in today's financial markets. Modern banks package auto loans, student debt, and corporate bonds into complex instruments that few investors fully understand. The collateralized loan obligation market reached over $900 billion in the United States alone by 2023. Rating agencies still assess these instruments using models built on historical data that cannot anticipate sudden market breaks. The structural incentive that corrupted Lehman's risk culture, originate, package, sell, repeat, has never been legislated away. Dodd-Frank imposed new capital requirements, but the largest banks today hold derivative books that dwarf their pre-crisis exposure. Commercial real estate loans are now deteriorating at rates not recorded since the early 1990s savings and loan crisis. Several regional American banks carry unrealized losses on their bond portfolios that exceed their entire tangible equity base. Silicon Valley Bank collapsed in March 2023 using a mechanism that Lehman's examiners would have recognized instantly. The Federal Reserve again became the buyer of last resort, the same emergency role it played across the autumn of 2008. Each rescue confirms that the system depends on intervention to survive the consequences of its own architecture. The question Lehman leaves open is not whether the next crisis is coming. It is whether anyone in authority will let the next one fall. Lehman Brothers did not collapse because of bad luck. It collapsed because leverage was mistaken for strength and complexity was mistaken for safety. Subscribe to our channel. Every video examines what actually happened, the documented evidence, the real names, the real outcomes, so you can read the pattern before it reaches you.